Hello, I'm Joseph Graff. This video is one part of a 500-part video series where I analyze the 500 largest companies in America. If you'd like to check out my other videos where I conduct stock analysis on other companies, I will include the link in the description. Also, I'd like to say that if you enjoyed today's video, please make sure you hit the like button and subscribe to the channel. Also, hit the notification bell so you'll be notified whenever I post future updates. Lastly, I'd also like to talk about M1 Finance. M1 Finance is running a great promotion right now where if you sign up using my referral link, we both receive $10 that we can use to invest in the stock market. I'll include my referral link below. Thank you all for watching, and here's the video. Facebook was founded in 2004 by Mark Zuckerberg, his roommates, as well as some of the other students that he attended Harvard University with. Facebook operates as a social media company. Its website, Facebook.com, was one of the first social media platforms ever and paved the way for other future social networks. Some of Facebook's notable services include Facebook Messenger, Facebook Groups, and Facebook Marketplace. All of these services can be used through their main website, Facebook.com. Facebook's operating segments include an advertising segment as well as a payments and other fees segment. In 2019, the company's most profitable segment was their advertising segment. This segment represented over 95% of their revenue and has been the company's main source of revenue ever since it was founded. Facebook has also been developing new products lately, such as the Libra cryptocurrency. It should also be noted that Facebook owns Instagram, which is a popular app for posting pictures. It is another social media platform. Facebook is the sixth largest company in America, currently valued at $527 billion. In this next slide, I will be talking about earnings and earnings growth. These two metrics are important because they are the driving force behind a company's valuation and thus the company's stock price. Companies usually report their earnings every quarter. Large, stable companies tend to have positive earnings, while companies with high growth potential may operate at a loss in the hopes that they will become profitable in the future. Understanding a company's earnings and earnings growth goes a long way in being able to accurately value a company. Facebook first became profitable in 2009 and has continued to be profitable ever since. In 2014, Facebook earned $1.10 per share. In 2015, Facebook earned $1.29 per share, a 17.2% increase from the previous year. In 2016, their earnings per share jumped up to $3.49. This was a 170.5% increase from the previous year. In 2017, they had another good year, growing 54.4% to earn $5.39 per share. In 2018, Facebook earned $7.57 per share, which was a growth of 40.4%. In 2019, Facebook's earnings per share actually dropped down to $6.43 per share. This was a 17.7% decrease from the previous year. This data indicates that Facebook has grown on average 42% per year since 2014. Now that we've looked at the company's earnings, we will now talk about its price to earnings ratio, also known as PE ratio. PE ratio is calculated by dividing a company's price per share by its past year's earnings per share. Generally, companies with low PE ratios are considered value stocks, while companies with higher PE ratios are considered growth stocks. PE ratio is a useful metric for understanding how Wall Street feels about a stock. In general, a stock with a PE ratio under 15 means investors are somewhat pessimistic about a company's future, while a PE ratio above 30 indicates that investors are optimistic about the company's future. As of April 23rd of 2020, Facebook was trading at $185.13 per share. This represents a trailing 12-month price to earnings ratio of 28.3. This is a bit higher than the trailing 12-month price to earnings ratio of the Standard & Poor's 500, which at the time of this recording was 20.1. In this next slide, I will be talking about the company's price to earnings growth ratio, also known as PEG ratio. This ratio is calculated by taking a company's PE ratio and dividing it by the company's growth rate in terms of a percentage. It is generally thought that companies with a PEG equal to or around 1 are fairly valued. Companies with a PEG above 1 may be overvalued, while companies with a PEG ratio below 1 may be undervalued. PEG is a popular metric among many investors because it takes both a company's earnings as well as earnings growth into account. As of April 23rd of 2020, Facebook was trading at $185.13 per share. This represents a 1.34 trailing 12-month price to earnings growth ratio. If you use this metric solely to value Facebook stock, it would appear that Facebook is overvalued. However, I caution against using this metric as the sole valuation tool for stocks like Facebook, as their large growth over the past couple of years makes their price to earnings growth ratio a bit difficult to use. In this next slide, we will go over the company's dividend yield, dividend growth rate, and dividend payout ratio. Dividends are generally a sign of a healthy, profitable, mature company. It does, however, indicate that the company feels it has limited growth prospects, as the company is choosing to pay cash to shareholders rather than reinvesting it into growth opportunities. Dividend growth rate is the rate that a company grows its dividend payments year over year. A high dividend growth rate is usually seen as a positive to investors. Dividend payout ratio is another important metric. It represents the percentage of a company's profits that it pays out as dividends. A payout ratio below 60% usually indicates that the company's dividend is safe and has room to grow in the future. A payout ratio above 100% means the company will almost certainly cut its dividend, as that means that the company is paying out more in dividends than it is earning. Facebook currently does not pay a dividend. They instead choose to reinvest their earnings back into growing the company. Facebook has expanded their businesses in recent years, offering a lot of new services and features on Facebook.com. Facebook could potentially offer a dividend in future years if their growth slows and they decide that the best use of their earnings is to pay shareholders rather than reinvest it into growing their company. In this next slide, we will be going over the company's price to book ratio as well as its debt to equity ratio. The book value of a company is essentially the value of all of its assets. Book value per share is simply the book value divided by the number of outstanding shares. Furthermore, the company's price to book is just its price per share divided by its book value per share. This metric can help you understand if a stock may be undervalued or overvalued. A company's debt to equity ratio is calculated by taking the sum of all of its debts or liabilities and dividing it by the total shareholder equity. In general, companies with a lower debt to equity ratio are better equipped to withstand an economic downturn. Debt, however, can be used by companies to grow and expand, which is why a high debt to equity ratio is not necessarily a bad thing. As of the beginning of the year in 2020, Facebook had a book value per share of $35.43. This represents a price to book ratio of 5.23. As of the beginning of 2020, Facebook had a debt to equity ratio of 0.32. which is a pretty low debt to equity ratio compared to a lot of the companies in the Standard & Poor's 500. In the next slide, we will look at the company's 3-year, 5-year, and 10-year return. A company's past performance does not predict its future performance. However, it does allow you to see how a company has done in recent years. In general, a steadily increasing stock price indicates a company has been operating successfully. If you had bought Facebook stock on April 23rd of 2017 and held it for 3 years, you would have seen an average annual return of 4%. If you had bought Facebook stock on April 23rd of 2015, held it for 5 years, you would have seen an average annual return of 15.6%. If you had bought Facebook stock on April 23rd of 2010 and held it for 10 years, you would have seen an average annual return of 19%. As you all can see, Facebook's stock price growth has slowed in recent years. In this next slide, I give my grades for this stock. I'll include grades for how I feel this stock is as a defensive investment, a growth investment, as well as an overall investment. My defensive grade takes into account how well I think the company would do in an economic downturn. My growth grade for the company takes into account how much I expect the stock to grow in future years. Finally, my overall grade is my personal opinion on the stock and whether I feel it is a buy or a sell. Keep in mind that these are my own opinions, and I am not recommending you purchase this stock or make any investment without doing your own research. As a defensive investment, I gave Facebook a grade of B-. As we talked about earlier, Facebook generates the majority of its revenue, over 95% of its revenue, through advertisements. I think even in an economic downturn, this advertising revenue would continue to come in, although maybe at a slightly lower scale. I also like that Facebook has a pretty low debt to equity ratio, which is a key characteristic I look for in a defensive investment. As a growth investment, I'm not quite as excited about Facebook. In recent years, Facebook has really been improving their site, offering new things like Facebook Marketplace and their new dating service. What concerns me about Facebook is their user base isn't growing as fast as it once was, and Facebook is kind of generally considered a social media platform for older people, and it seems that younger people tend to use Twitter and Instagram more, as well as Snapchat. As an overall investment, I gave Facebook a C+. I'm not excited about their growth prospects, but I do think that they are a solid company. I think they'll do fine. There's just nothing that really excites me about their business model or what they've been doing in previous years, with the exception of their Libra cryptocurrency. That could be interesting, but even then, there's a lot of questions regarding the regulation and whether the government will actually allow them to use that cryptocurrency. So that's why I decided to give Facebook a grade of C+ as an overall investment. That'll wrap up today's video. If you enjoyed the video, please make sure you hit the like button down below and subscribe to the channel. I'll be doing this type of video for every stock in the Standard & Poor's 500, so keep your eye out for future videos. Thanks again for watching, and take care.